Is ChatGPT the ultimate investing assistant or a financial trap waiting to happen? The truth is, it's both. I've helped millions improve their finances, and I'll give you the complete playbook, the 3 AI superpowers that will revolutionize your investing game, and ways to avoid the hidden dangers that could destroy your portfolio. You have endless tabs open, confusing reports, and numbers that blur together. Researching investments normally takes hours. AI can do that in just minutes. Instead of scrolling 50 headlines, you can paste them into AI and ask for a 5-sentence summary of the week's market drivers. You instantly know what matters without drowning in the noise. Or let's say you're reviewing an earnings report. AI can highlight revenue growth, profit margins, and major changes in plain English. That saves you time and gives you clarity. Pro tip: always ask AI to list its sources. That way you know exactly where the summary came from and you can double-check the most important details. The next superpower changes the whole game. Investing isn't just about picking stocks, it also involves spreadsheets, number crunching, and organization. That's where AI shines. It can sort transactions from a messy CSV file, compare 2 funds side by side in seconds, or pull out KPIs from your financial data without formulas. Think of it like an unpaid intern. It does the grunt work so you can focus on strategy. Pro tip: don't be vague with prompts. If you just ask what's the best stock, you'll get shallow advice. But if you say, looking at the latest earnings report, which of these stocks stands out and why, you'll get more specific and detailed advice. But the real secret is still hiding in plain sight. AI is incredible at scanning large datasets and surfacing patterns. It might highlight that a fund has higher turnover than its peers, or that certain sectors keep popping up across reports. That kind of pattern recognition can help you ask smarter questions and explore opportunities you'd never notice on your own. Pro tip: remember that AI doesn't know your goals. It can show patterns, but it can't decide if those patterns fit your time horizon, risk tolerance, or family needs. That's your job. The next piece connects all the dots. So what's the best way to get the upside of AI? Do what the pros are already doing. First, ask AI for a summary with sources, then have it highlight one main upside and one main risk. Finally, check that risk in the original document yourself. This way, you gain AI's speed and clarity, but keep your own judgment in the driver's seat. Those AI superpowers are real and they work. But here's what most people don't realize. If you get too comfortable, AI stops being a tool and starts becoming a liability. Now that you know how to use AI for speed and clarity, let's talk about the dark side. The hidden traps that can cost you serious money. It starts with the biggest danger of all. The first danger: AI always sounds confident. You ask it a question, and in seconds it gives a polished, professional-looking answer with neat charts and lists. But here's the hard truth: a polished, wrong answer is still wrong. AI doesn't truly understand markets, it only processes patterns in data. And when data is missing or messy, it doesn't stop. It makes up something that sounds right. These hallucinations are an investing nightmare because you might act on fiction without even realizing it. Imagine asking, "What are the risks of this new fund?" And AI casually lists 3 risks that don't exist in the official filings. Sounds legit, but you just based a real money decision on made-up info. Bottom line, don't mistake confidence for correctness. Here's the part almost everyone overlooks. AI is only as good as the data it's fed. Accurate current data can give you useful summaries, but outdated or biased data, that poisons the output. Think of a calculator. If you punch in the wrong numbers, it gives the wrong answer confidently. AI works the same way. Let's say you ask AI to compare two mutual funds. It says Fund A outperformed Fund B by 10% over 5 years. Sounds impressive, but what if it ignores the much higher fees? Suddenly, that better fund leaves you worse off. Bottom line, always assume the data could be incomplete and double check. And here's the catch no one talks about. AI is great with patterns in past data, but when it comes to current events like regulatory changes or lawsuits, it stumbles. Ask it about a company's health, and it might summarize revenues perfectly, but it could skip over a pending lawsuit or product recall buried in the fine print. That missing detail changes everything. And here's the scariest part. AI won't tell you what it missed. It just presents a clean, confident summary, while critical risks stay hidden. Bottom line, never assume AI showed you the full picture. Ready for the part that changes the outcome? Now that we've uncovered the dangers, here's how to avoid them. You don't need to ditch AI, you just need guardrails. Follow these 3 simple habits. Always ask for sources. If AI can't show you where its information came from, don't trust it. Spot check at least one number. Open the original source like a company filing and confirm a key detail yourself. Use AI as a starting point, not the finish line. Think of it like Wikipedia. It helps you start research, but it's not the final word. Remember, AI can save time, but it's not magic. Treat it like an unpaid intern, not a financial advisor. It can collect notes, sort data, and save you time, but would you let an intern sign your mortgage papers or pick your retirement plan? No way. They gather the notes, you make the final call. But even with AI's help, you're most likely losing $375,000 because of one investing mistake. Watch this video to learn how to easily fix it.